The limited partner shares in the potentially outsized returns of a well-planned and executed investment, but is a passive investor with no day-to-day operating requirements and whose liability is limited to the extent of their share of ownership. The limited partner has the maximum leverage on their most precious asset, their time. Now, they say you're the average of the people you surround yourself with. Are you looking to elevate your network? Connect with individuals that bring your average up? This is more than just a podcast. It's a community to learn, to participate, and to connect. There is no other community out there like this specifically for limited partners. So subscribe to the podcast, and most importantly, join the community at thelimitedpartner.com. Welcome. I'm your host, Jake Wiley. Welcome, partners. This is your host, Jake Wiley. This week, I'm joined by Brian Burke. So he's the CEO of Praxis Capital. He's been there for over 20 years and the author of The Hands-Off Investor, which I've read, and I think it's a fantastic book. And I think it's right on with what we're talking about here on the show. But I'll turn it over to Brian. Brian, welcome to the show.
Jake, thanks for having me on. And I'm glad to hear you were able to suffer through all 350 pages of The Hands-Off Investor. Thanks for taking the time.
Oh, man, it's right up my alley. I'm an accountant. I'm a CPA by training. I love the technicalities. I think those are the things that it's the nuances and the technicalities that really make this thing work.
Funny you say that because writing this book was a bit of a challenge because, you've got to try to appeal to people who really want to understand the granularity of how numbers work in a passive real estate investment. Yet at the same time, you don't want to put to sleep the people that just kind of want an overview. That was an interesting tightrope to walk, I must admit.
Yeah. Did you get a lot of feedback on that along the way, trying to figure out where was the line?
Yeah, I didn't quite so much. I tried to make it up on my own, but the feedback that I got, it was interesting because I had a lot of people review this book before we published it. And I had the technical ones who said it was so great because they had all the technical detail. And I had the high level overview types that said that everything they wanted to read was there. So I felt like I might have struck at least close to the balance. So fingers crossed.
Yeah, I thought it was great. So, and it's definitely something I would recommend to you, my listener. Go out there and read it. It's what you need to know. And it's not a complex business, but there are nuances and you have to do it right. And you have to work with the right people. But we'll get to that in a second. Brian, you've been doing this for, 2-3 decades now. I'd love to give my audience a little bit of a background on who you are, so then we can kind of dive into why you wrote the book and the impetus and some of the stories that you've got. But if you wouldn't mind sharing a little bit of your journey.
Yeah, my journey started as a house flipper 33 years ago when I was 20 years old and trying to figure out what I wanted to do with my life. And I made my first real estate investment by buying what at that time was intended to be a rental property with no money down, because I read a book saying that you could buy real estate with no money down. And I thought that describes me. I have no money. So this is perfect. So I bought my first property and never looked back. 20 years, 30 years later, I'm still at it, but not so much in the house flipping side. Our business grew over the years. When the great financial collapse happened in the mid, to late 2000s, we expanded our business exponentially on the house flipping side. We were doing, 100 houses a year and bought a massive rental portfolio of over 110 houses in the San Francisco Bay Area, kind of at the bottom of the market. And then we'd raised a lot of money from investors to make all of this stuff happen. And, I came to the realization that eventually all these foreclosures we're buying are going to vanish, and all these defaulted loans are going to work their way through. And, then what? What are we going to do to keep investors happy or provide them with alternative investments after this is all over with? And multifamily was a business I got into in about 20 years ago when I made my first personal multifamily investment via a 1031 exchange from some of my rental properties. And so I decided that maybe we should look at focusing more on the multi side because it was more scalable and more sustainable versus house flipping, which comes and goes in waves. So we did that and never looked back. We've done over 4,000 units since making that decision. And it's been a great ride. We've raised over $200 million from passive investors and never lost a nickel of investor principal. So certainly something to be proud of.
Yeah, that's a great story, right? And I think that when we think about what is the objective number one is don't lose money. And objective
number two is see objective number one.
That's right. That's right. And it's surprising how risky people will get. And I see, I think this market, and I think we come back to it, like this market where things are so moving so fast, the market's so hot, cap rates are compressed so tight. I look at a lot of deals and there's a lot of deals I'm just totally not interested in, right? Because I can tell that, people are just trying to like churn. But let's get back to the book. Tell me, why'd you write the book?
Well, I wrote the book because obviously through this course of business, we talk to a lot of investors and I hear their questions. After a period of time, I realized that the investors were asking us all the wrong questions. The questions that were important were completely being ignored, and the ones that didn't matter at all were the ones people seem to be so focused on. And so in trying to figure out why that was, I realized that there's no source or resource out there for investors to learn, passive investors to learn how to invest in passive real estate syndications. There's plenty of books out there that will teach you how to buy real estate for your own account, but there's nothing out there that really teaches you how to invest passively. This was never driven home. This point was driven home to me about 15 years ago, I guess it was closer to 12 years ago. A friend of mine had invested in a passive real estate syndication. She was a grocery clerk who had bought a fourplex early on in her career, and it just had appreciated in value tremendously. And for a grocery clerk, that's a significant amount of money. She sold the property in a 1031 exchange and invested all of the proceeds into a passive real estate syndication that was organized as a tenants in common structure. It used to be known as TICs. And the TIC allowed the sponsor to accept 1031 exchange money, where a conventional passive real estate syndication would not allow for that. So, wanting to do this 1031 exchange, this is the investment route she chose to take. She invested all of her money in this thing. And lo and behold, 2 years later, the thing goes belly up. It was revealed that the sponsor of that investment was a convicted felon. He had stolen all of the money out of the accounts and basically flew the coop and left the investors hanging for millions and millions of dollars. Lost investor principal, just gone into the wind. The investment properties all went into foreclosure, were taken back by banks. The investors recovered nothing. And my friend lost her entire life savings. So instead of being thoroughly, fully set up for retirement, instead she's driving for a rideshare service just to put food on the table. And I thought, if I could just somehow prevent that from happening to one person, then writing this book would be worth it. And that's what I set out to do, was to teach passive investors how to properly think about their passive investing strategy, find the right investments to invest in, and more importantly, how to find the right sponsors to invest with.
Man, that's a powerful story. When you think about, what I've seen, right, is a lot of people that can talk the talk the best are the slipperiest folks out there, right? They've got the shiniest presentation. Everything looks great. But how do you dig in and really get to the next level and understand who you're working with, right? Because there's folks like me who grew up as a CPA, right? It might just be a little harder for us to convey our enthusiasm and the excitement we have about an opportunity. It might come off a little bit flat, but I guess along those lines, what are some of the biggest mistakes you see folks making when they're looking or they start making passive investments?
One of the biggest mistakes, and this was somewhat started by this crowdfunding trend. A few years ago, websites came up onto the scene that would offer investment opportunities, kind of like shopping on Amazon. You put in your criteria and bam, up on the web page comes a menu of 15 different things you can invest in. And people have this tendency to look through the list and scroll through and find the one they want and go, aha, That's the one. It has the highest projected return, and that's what I want. I want the most money for my investment. So I'm going to invest in the one with the highest return, and they would pick that one, and that's how they would choose. And it could be a life-changing mistake. The reason that return might be so high is the sponsor might have no idea what they're doing and completely misunderwrote the returns and is just throwing numbers out there. It could be somebody that like in the case of my friend, is a criminal and is just trying to attract investments and make off with the money. I mean, there's no way to know for sure. So people weren't doing their due diligence, and that's probably turned out to be the biggest mistake. And people have lost a lot of money by investing just with the wrong people. It could have been the right deal, but managed by the wrong people that think can go belly up.
Yeah. You think about folks investing money, right? Like a lot of folks grew up, they got a 401k with their company, maybe they left and they just handed it over to an advisor, and like all things considered, the market's gone up and they've just earned money. And there's really hasn't been a whole lot of diligence. There's an expectation that if you have a financial advisor, they've been through some course, there's some sort of certification, they know what they're talking about. And then I think that a lot of times that attitude is pervasive and kind of carries on when you start looking at like alternative investments. And, there is, a sense of, oh, okay, well, you're in the business, you know what you're doing. Like I saw your deck, it looks good. Let's just go there. And I think, yes, the idea is to be passive, to be hands off, right? This is not to create another job, but at the same time, like you do have to do a lot of work on the front end to know that you're getting it right. And I mean, that's exactly what your book's talking about.
Well, I mean, the book is How to Invest Passively in Real Estate or in it's the subtitle of the book is Investing in Passive Real Estate Syndications, right? Because people say, I want to be a passive investor. There's a difference between being a passive investor and investing in passive real estate syndications. And that may seem like a subtle sentence, but the reality is that syndications are meant to be passive. You're an investor, you have no control over the investment, but from the investor's point of view, it's anything but passive when you're in the selection process. You need to be a very active participant in the process when you're deciding who you want to invest with before you turn passive. And so it's difficult because people get into passive investing because they want to be passive, right?
That's
they
right.
don't want to do all this work, or otherwise they'd go buy real estate themselves. But there is a payoff. If you can invest with the right person, you can do your due diligence and be active in the beginning, but then you can kind of turn that around and turn more passive once you've done all that homework and made a good selection. You still have to watch it, make sure that the reports are making sense and all that, and ask questions when appropriate, but got to be prepared to do a little bit of work up front.
Yeah. I mean, I think the work up front is everything. Let's talk about that a little bit. What's the first step for somebody that is looking to put their money to work in a syndication? What would their first step be to find the right partner?
Well, that's a very good way to ask that question, to find the right partner, because generally what most people ask me when they say, hey, I want to invest passively, how do I find the right deal to invest in? And, that's 100% the wrong question. It's not about finding deals to invest in. It's about finding the right partners to invest with. And it's a significant distinction, because when you're thinking about who you're investing with, your due diligence completely changes from what you're investing in, right? That's a different set of due diligence. But that is really the way to get started. The way to get started as a passive investor is to find the right groups to invest with, the right company, the right people. Do your homework, make sure that you're very comfortable with them. And then once you've checked the box, so to speak, and you've determined that they're the right people for you, then the next step is when they present you with an opportunity to invest in, you do your due diligence on that particular offering and make sure that checks all of your boxes. But to start with, you've got to make sure that you've got the right partners. And the questions you want to be asking are questions along the line of, how long have you been doing this? What's your track record look like? Can you document, do you have some documentation I can look at related to your track record? How many losses have you had? What did you guys do about it? It's all about trying to determine two things. One is their history and their capability as operators. And the second is their moral character, because at the end of the day, their moral character really is the glue that holds everything together. They could be the best operator in the world, but if they're a crook, they're going to steal your money. They're going to steal your money. So knowing that you have someone trustworthy is kind of the other big box you got to check. So the main two boxes are character and track record / experience.
Yeah. And I appreciate you calling me out really at the beginning of this conversation about, I almost take for granted that we're starting with who, right? In this journey. And, for those of you who are listening, this is also a cheat for me, the podcast, right? I talk to people all of the time, and there's a selfish reason is that I want to make connections with the right people in this industry. And the other point, which I think kind of goes back to your original concept of you're a house flipper. So that's how I started, my business. Well, I started with some real estate investments, but got into flipping during, when the financial crisis started to turn, because that's where it was, right? It wasn't sitting around holding it. It was like everything was moving. But, when we look at getting into passive investments with syndications, I can get the same returns without all of that headache. It's a lot of work to flip a house. It's a lot of work to put all those things together. And if you think that going into real estate can be a financial boon to you, the answer is you're right. But you see these shows where they're flipping houses in a week, it doesn't work that way. But can I leverage somebody else's time that's doing a great job to get the same returns and be passive? The answer is yes, right? And that's the whole purpose of this, investing in a syndication. But you got to do a lot of diligence on the front end. And I think maybe to your point as well, is that once you find the right people, you don't have to invest in everything they do. You might say I don't want to get into office, right? I want to do multifamily, or I want to diversify a little bit. I need to look at somebody else that does a different type of property. But once you find the right people to work with, you don't have to, I wouldn't say your work is done, but it's not nearly as hard, right? There's an initial lift to get into this thing. Is that a fair statement? It
is a fair statement. Another thing you said there that I think is key is you said, find the right people to work with. And sometimes people get so locked up in thinking, maybe they want to find the right person instead of the right people, where they want to invest in only one group. And, I'm a strong proponent of eliminating, to the extent possible, any single point of failure. And if you recall back to my story about my friend, the grocery clerk, she invested all of her money with one operator in one project. So there's multiple single points of failure. You have a single point of failure that you're invested with one operator. You have a single point of failure that you're invested in one real estate asset. You have the single point of failure that you're invested in one geographical market, and you have the single point of failure that you're invested in one particular sector, which that one happened to be senior housing. So, if you have a passive investing strategy, which you should have if you're considering becoming a passive investor in real estate syndications, that would mean that your goal should also be to try to eliminate, or at least to the extent possible, minimize single points of failure. That might mean that you'd be investing with multiple sponsors rather than putting all your money with only one. It might mean when you invest with one sponsor, you might invest in a fund that acquires multiple assets instead of just one. It might mean that you invest in multiple deals with that sponsor that are in multiple geographic locations. Now, I would say to a lesser extent, investing with one sponsor in multiple asset classes. That's a little bit more dangerous, because I feel that you really want to invest with people that are experts in their field. And, just because you're great at multifamily doesn't mean you're, the best office operator or best hotelier or whatever other type of real estate or self-storage or whatever. So, that might mean you want to invest with a self-storage operator. You might want to invest with an office operator and a hotel operator if you're so inclined to believe in those particular sectors and feel that you want to have exposure to them and diversify out of not just simply investing in residential assets. So, I feel that, it's really important for people to spread their risk around. This business seems to be approached backwards by passive investors, as they want to look for maximizing return rather than minimizing risk. And to an extent, I understand that, but you can't make any money at all if you lose all of it. So, mitigating your risk first and foremost is I feel the best strategy, and then let the returns fall where they may.
Yeah. I mean, I think that's a really great point. Both of us, we've lived through the cycle, 2008, 2009 cycle, and buying properties was a great time to buy properties. Owning properties, holding properties, having acquired properties just before, the downturn was very stressful. And there was a massive movement in values of properties. And there was strategies and backup plans and backup plans that had to go into effect to get through that. And I think that in the current environment, everything seems like it's pointed up. And I think that to your point about investing with specialists is that I think you want to be with people that have been there and kind of lived through some of the cycles. And then two, understanding the nuances of the deal and having some conservatism in the projections, because when these numbers get big, small movements in projections or a little bit of optimism in the wrong places can make a return look great on paper. But the reality is that, you're cutting it to the core and everything has to work perfectly. And we all know that that's not the way the world works.
Yeah. One of the concepts in the book relates to, looking into the experience of the sponsor, and experience includes multiple facets. If they're investing in apartment buildings, you want to know if they have experience in apartment buildings. If they're investing in Chicago, Illinois, you want to know they have some experience in Chicago, Illinois. But at the same time, you also want to look for experience like market cycle experience. That means have they been through and survived a market cycle? If they've been in business for less than 10 or 12 years, they've only seen an up market for their entire career, and they don't know how to navigate an adverse market. And I think it's important, especially as this up market gets more and more mature, the experience of having survived an adverse cycle becomes increasingly valuable as another adverse market cycle gets closer to rendering its ugly head. And then another component of experience that I think people need to consider that oftentimes they don't consider, in addition to all these other ones we've already laid out, is full cycle experience. And that means that they've actually bought, successfully managed, and sold and delivered a return and return capital on real estate. And you'll be amazed how many people are raising money for deals and they've never successfully round tripped anything. So I like to say that they've been proven that they know how to take off and maybe even fly the plane, but they haven't proven that they can land. And, in order to successfully complete a trip, you need to do all of those things. And so you want someone that's proven to be able to have done all of those things.
Yeah. And I mean, that's the other point, right? Like your investments are liquid. 3, 5, 7 years might be the cycle that you're playing with. And that's a long time, especially given where we are in the market cycle. What's it going to look like 3, 5, 7 years from now? So, having the maturity of how are you going to get there, right? And what's it going to look like on the backside, and planning for changes and cap rates decompressing and things looking different. Brian, I guess any other tips, really hot button items that us LPs should be looking for in deals?
Well, I'll tell you one of the ones that it cracks me up, because people place an extraordinarily high amount of emphasis on so-called skin in the game, but they mismeasure it. So one of the things that I've heard all too often out there is investors ask sponsors, how much money are you putting in the deal? Because they want to know that sponsor is eating what they kill, that they have skin in the game, and et cetera. And I've heard too many passive investors say that if the sponsor is putting in X number of dollars or X percent of the capital, that checks all the boxes for them. They're good enough and ready to go. They'll invest. If the sponsor is not putting in whatever it is that meets that threshold, then they fail and they don't invest. And it's, in my opinion, one of the most overemphasized or overly relied upon measurements, but it's also one of those things that people measure not because it's important, but it's important because they can measure it. And it's just a completely wrong way of looking at things. And, I would suggest to people to place less emphasis on how much money the sponsor is putting into the deal and more emphasis on that sponsor's track record, their experience, their diversification level, and all those other things, and not let that other stuff slide just because the sponsor is putting money into the deal. And that may sound counterintuitive, but let me put it this way. If the sponsor is a crook, it doesn't matter how much money they're putting into the deal. They can raid the bank account, take out every dime they put in before they flee to Jamaica or wherever it is that they go to hide from you. So their character is equally important. You cannot overlook all the other factors because you check one box. You have to look at the totality of the circumstance. To me, a greater degree of skin in the game is achieved from someone who has a long track record that they don't want to destroy, a brand that they need to protect. In other words, they can't just, pop up 6 months later under a new flag and call themselves something different and start attracting capital again. Everybody would know who you are and what you did. So you can't get away with that. Now you have to defend your investors to the grave because if you screw it up, you're finished. I mean, to me, those things are more important elements of skin in the game than any number of dollars. And another good one is who's guaranteeing the loan. Even non-recourse loans require a carve-out guarantor for bad boy acts such as fraud and a bunch of other things. Who is signing that covenant? Oftentimes you'll find sponsors are hiring that function out by bringing in some wealthy person with a big balance sheet and giving them some minute piece of the deal or some fee in exchange for signing on the loan carve out, and the sponsor has essentially no obligation. Therefore, even the debt lender can't come after the sponsor. And so if the sponsor isn't signing on their own carve out guarantees, that would be, to me, a red flag and a lack of skin in the game. So if you are concerned about skin in the game, think about it not just as dollars, but as about a whole totality of the circumstances when you're considering who really has skin in the game.
Yeah, and I think that's a fantastic point, right? It's rarely emphasized that way. And then, the other side of that coin too is that, the investment, like we mentioned before, 3, 5, 7 years long, how is that asset going to be managed during that period, right? Like these are questions that I'm asking. Is that okay? Fine. Like we put our money in, like the assets out there, it's working. How are you going to maintain that through that period? Like what's that operating cycle look like? What's the asset management fee? Is it enough? Right? Because I know people like play with points here and there to make their deals look a little bit more, I guess, palatable. But at the same time, I just want to know that it's, that there's enough money basically set aside through the process to watch it for the whole period.
Well, you want your sponsor to be worried about your investment, not worried about how they're going to make their own house payment. So that's certainly right. You do want their attention focused. And that means that you want to make sure that they're fairly compensated, and people do tend to try to want to grind on fees and that sort of stuff, which is the wrong emphasis, in my opinion. They really need to be more concerned about, as you said, how that asset's going to be managed. It's interesting how the emphasis by a lot of sponsors seems to be so focused on deal aspects, acquiring, and we have this great chain of off-market deals. We got this deal flow and that deal flow, and and everything else. But that process in the life cycle of an investment takes weeks to months versus the operation and ownership aspect, which takes months to years to decades. And that's really where the rubber meets the road, and their ability to manage that asset is extremely important. And this, comes back to this money in the deal thing again. I don't need to beat this dead horse, but it's comical when people say that, having money in the deal means that they're going to manage the property better because they're going to be looking after their own dollars. Well, that's just simply not true. If they're inept, incapable operators, they're going to screw up their own investment just as much as they're going to screw up yours. And if they're unscrupulous, they're going to make sure they get paid and take their money out and let you suffer the consequences anyway. So that's not enough. You can't say that that's enough. You really have to look at their experience and their operating track record to understand how well they not only operate, but how they manage adversity. And, and also this is one that's harder to quantify, but no less important, is how do they communicate that adversity? And when things go wrong, does this sponsor have a track record of telling people about it or sweeping it under the rug and hoping no one notices? And you'd be surprised. There's a vast array of variation from sponsor to sponsor in that regard.
Yeah. I've heard that over and over again, that the most probably underappreciated part of a business for a sponsor is investor relations. And it's how you communicate, how often you communicate, what you're communicating. And bad news is never great, right? But if you just tend to want to sweep it under the rug because like, oh, next month will be better. Next quarter will be better. We'll just deal with it. Investors are tolerant of bad news if you tell them, but they're going to be a lot less tolerant, and their confidence in you is going to be shaken if they don't find out about something until a month, quarter, whatever your next reporting cycle is, when you should have known early. Because then they're thinking, oh, what else are you not telling me?
Or they don't find out at all. I mean, there are sponsors that are out there that will just simply make distributions to investors out of reserve cash that was supposed to be used for property renovations, just to sweep under the rug, underperformance at the asset level. It's really bad news because the business plan just ends up in a tailspin and a vicious spiral. Now, oftentimes those groups will get bailed out by an rising market. If the market turned while that was going on, they'd be in a world of hurt and probably facing some serious investor losses and a lot of really upset people. So every sponsor, no matter how good they are, and no matter how good their judgment is and how long they've been doing this, is going to get deals that don't go according to plan. It's just going to happen. That's part of life, and no one is exempt from that. The question comes down to, are they honest about it? Do they tell the investors, hey, we're not distributing any money because this is what's happening right now, and things are not going according to plan, and this is what we're doing to try to rectify the situation? That's what investors want to hear, not, oh yeah, everything's going great, and here's your 8% distribution on a property that's actually negative cash flow.
Right. Well, this has been a fantastic conversation, Brian. I really appreciate you. And if you take away one thing from this conversation, it's starting with the right people, finding the right folks to invest with. We kind of joked about it at the beginning of the conversation, but the book is 300 pages, right? It's not, you don't just go throw your money at somebody and walk away and then expect big returns. There's some work to be done, but the path has already been trod, right? This is not new. And there's a lot of opportunity and a lot of great people to work with out there. You just have to find them. And it's going to take a little bit of work on the front end. But Brian, thank you.
Thanks for having me on, Jake. I really appreciate it.
Yeah, great conversation. I hope you've enjoyed this episode of the Limited Partner Podcast. Please subscribe and leave a review. If there's any reason you wouldn't leave us a 5-star review, please email me at jw@jakewiley.com. Your feedback is always appreciated. The show is just the tip of the iceberg in terms of the limited partner community. It's a community where limited partners can come together to learn about what best in class looks like, and opportunities, and most importantly, a place to connect. There is nothing out there like this. So head over to thelimitedpartner.com and sign up. We'll see you next time.